Hello. Today we're going to talk about Chapter 5, Professional Auditing Standards and the Audit Opinion Formulation Process. We're going to focus more on the opinion formulation process and discuss in a more general sense what auditors need to do and what phases of an auditing engagement and what work auditors need to do. And in this process, we're going to discuss the goal of auditors. We talked about it. Auditors need to make sure they lower the probability that their audit opinion given to the financial statements is wrong, right? And what do we mean by is wrong? What aspects of this opinion auditors during their audit work need to pay attention to, need to be careful with, and how they determine they can more comfortably deliver those opinions to the public. First, let's talk about financial statements, right? When we think about financial statements, we have assets, we have revenue. And for those items, right, a company may have 5 pieces of land, and if a company reports more than they have, 6 pieces instead of 5, then the company, in a general sense, will appear to be better than they actually is, right? For example, company had 1 million sales, 1 million transactions, numbers of transactions, not total amount, but the company purposely report more sales transactions than it actually had, right? So those decisions will inflate companies' financial statements, either inflate balance sheet if they report more assets than they have, or inflate earnings through inflating revenue if they report more sales transactions than they had, right? And in this case, financial statement users will be misled because the inflated numbers will deliver a picture that is better than it actually was, right? In this case, those whoever relied on the false prosperous pictures of the company, of the financial statements, made the wrong decisions, right? They will suffer loss, and auditors give the wrong opinion, right? So if we talk about this, we know that overstatement or reporting more than what a company has is an issue, right? If the company choose to report more than they actually had, and auditors fail to catch it, then we are saying that the financial statements have existence issue. What do we mean by existence issue? Because those transactions reported do not exist, and the auditors fail to catch that, right? So one thing, when auditors audit financial statements, they are worried about existence of certain items, and those items are more, in a general sense, might be assets or revenue items, because in general speaking, the more, the better. Right, so it's an existence is one of the things we have to worry about, auditors worry about, care about, and the companies care about too when we audit. Right? So that's one of the assertions. And also, if we talk about expenses, and if we talk about liabilities, for example, if you have a client who borrowed from 6 banks, but they chose to report only the debts from 4, right? Lower debt, in general, it looks better. It makes company looking better and safer. Or, for example, company had 1 million expense items, 100 expense items, but the company tried to report fewer expense items, expense transactions than actually has, right? So lower the expense, higher the net income. Company appears to be better, right? In this case, right, companies, they still make financial statements, inflate financial statements, making them looking better than they actually were. They inflate financial performance by deflating either debts and expense items, right? And if auditors fail to catch those fraudulent activities, then auditors might be in trouble because those who relied on financial statements to make decisions will be misled as well, right? So the second item is a little bit from the second assertion is a little bit from the first assertion, that the first assertion we call them existence issues because companies report more than they actually had. They reported what they didn't actually have, right? The second item, they didn't report everything. For expense items, for liability items, they chose to report fewer items than they actually have, right? In this case, it's not existence, but it's completeness. From the company who perform those fraudulent activities perspective, we are saying that the company didn't report everything they had. They hid something. So we are also concerned with existence issue, completeness issue, right? So the first one is existence, second one is completeness. They don't always go together, right? We are more worried about existence issues for assertion for asset items and revenue items. Auditors are more concerned with completeness due to for liability items and expense items, right? And also we know that for financial statements, when we look at the financial statements, no matter it's cash, AR, inventory, intangible asset, or patents, we know they have to report it in dollar amounts, right? So we need dollar amounts to be accurate as possible. So we call this valuation. Valuation for some particular assets are pretty straightforward. For example, of course, we need the value to be accurate, but for example, if there's a loan borrowed from the bank, it's not going to be difficult to verify because when they borrow from the bank, there's going to be loan contracts and there's going to be cash records, bank records regarding cash coming. Auditors can always match. If the company bought inventory, there's going to be invoices, right? There's going to be accounts payable and cash payments. So some accounts, the valuation, the value of those items, it might be an asset, it might be a liability, it might be a sales revenue income, it might be expense items. They're pretty easy to be verified because there's going to be documents underlying it. But some are pretty tough, right? Some people just learned pension expense. It's an estimate. It's not easy, right? And we also have, for example, allowances for doubtful accounts. We know aging methods, aging analysis, but it's not easy to determine because how do we know whether when the company, when AR is overdue by 30 days, whether it's 10% or 20%, right? Some, especially when the account involves estimates, right? Estimates by definition it's not as objective as the other accounts, right? They might be more likely to be subject to manipulation, right? So valuation is another thing we need to deliver. And also so valuation is a third assertion, right? Regarding financial statements, auditors need to be careful with. And if we also think about an example we covered in the first class, right? For example, when a company, how many people watched this? I remember there was in History Channel, there was a show called Repo, right? There's two big guys driving everywhere, taking people's cars back, right? And there's always going to be someone coming out shouting, "That's my car, don't take it, I haven't used it for work," something like this, you know? Feels bad, but why those big guys can take those other people's car? Because technically it's not those other folks' car yet, right? They might be under the title or not untitled. They might be shown that they bought it, but you know, their car was used as a lien, right? So they can get the loan to finance them buying the car. As long as they are paying it, they have the car. But if they stop default, the bank can have those repo people take it back, right? So what does it mean? Meaning that if this were your car, if you have a car, what we mean is you can sell it, you can choose to buy insurance or not, you can choose to buy liability insurance or comprehensive insurance, you can give it to other people, you can trash it, right? But if it's something you bought with financing, there's a lot of things you cannot do, okay? What does it mean? Meaning that if you bought it with financing, for example, you are using your car as a lien, right? As a collateral, okay? So it's not actually your car, or your rights to the car is not as much as to whatever, for example, your phone or your calculator, your pen, okay? So rights is something we need to be careful with. Rights and obligation is another assertion, the fourth assertion we need to be careful with, right? Obligation, I think, is quite easy to understand. If somebody is in a, for example, oil and gas company, right, there's always a risk. They might be obligated to keep the environment clean. And also, if you, for example, run a company and you co-sign a loan for your brother's company, then although it's not loan yet because your brother didn't run away yet, right? But there's always a potential. You need to let your investors know, right? If your company borrowed a lot of money to expand and you used your, let's say you used all your assets as collateral to borrow the money, then your investors need to know, your co-owner need to know, because if they didn't have the information, if they thought you might not lose your assets, everything, right? Had they have the information, they might change their decision. So those information needs to be disclosed, and the companies usually, they don't like the idea of disclosing it, and auditors need to make sure they're disclosed, right? So rights and obligation. The last one, presentation and disclosure, right? Remember, we talked about PPE, AR can be the same thing, right? Two companies, both of their PPE shows 5 million. The first company is 10 million historical cost, 5 million accumulated depreciation. The second one, 100 million historical cost, 95 million accumulated depreciation. So without the required forms of presentation, just from the net value 5 million, right? We don't know which company is better off, or we think the two companies, we wouldn't be able to tell the difference between the two companies, right? 10 million historical value, 5 million accumulated depreciation, 100 million historical cost, 95 million accumulated depreciation, right? We don't know at all because the net value is the same. But a GAAP requires us to disclose, to present PPE in financial statements in the format of historical cost minus accumulated depreciation, then we have the net value for a reason, because when we look at 5 million accumulated depreciation out of 10 million historical cost, we know 50% used, right? When we look at a 95 million accumulated depreciation against the 100 million, we know 95% used. So our opinion might be different. However, on the other hand, right, that being said, we still need to look at useful life to determine which one is going to be really used up, right? The 5 million left 5% might be small, but the useful life might be another 10 years, right? The 50% might look at a lot from a percentage perspective, but it may be running out in 2 years. Those useful life, they are also required to be disclosed because they are vital for financial statement users to make decisions. And often, those who want to commit a fraud don't want to disclose it. So auditors need to be careful with it too, right? So when financial statements, how financial statements are useful, they provide financial information, and how to make sure a set of financial statements won't mislead, right? Won't mislead investors who are able to interpret financial information, right? We want to make sure 5 things. Existence, meaning that everything company reports, they must exist. Completeness, everything company have, they must be reporting everything. Everything had or took place. And evaluation, the value must be accurate, or when it's estimated, reasonably accurate, right? Presentation and disclosure, rights and obligation. Okay, so those 5 things are the qualities. We call them assertions. There's qualities financial statement users want financial statements to deliver, and they are required by GAAP to deliver, right? And of course, when we have rule, we need somebody to enforce it. We need some auditors to oversee it, right? So auditors, when they're auditing, they actually want those 5 things to be delivered, right? That's that's auditing work. And we do all those auditing work for what? Okay, so we can look at how auditing, we're going to talk about from chapter 7, we're going to talk about detailed auditing, but at this stage, let's take a look, right? Look at how auditors do their job, meaning how they, from the beginning, work all the way to deliver their financial statements, all right? First, let's be aware that we call it phase 1 in the book, okay? Auditors will need to make either accepting a new client or continue with the client. Most auditors' clients, they are continuous. We worked with them last year. They are not unhappy with us, so we decided to do it again, all right, this year. Or this is a new client who's not happy with the auditor they had, they decide to switch to us, right? So no matter what, auditors need to make a decision. Without anything, you talk about annual and other anything case, right? You can see that how devastating having a bad client can be. You might think you are gaining some extra bucks in the short run, but it ended up you lose all your company, right? Such a big global company just collapsed overnight almost. So auditors need to be careful with this client, right? they need to be careful that they have the expertise to do the client. For example, if you are a small audit firm, you always audit oil and gas companies. Now there's a bank wants you to audit them because they heard that you're a hard worker. Should you agree or not? My suggestion is you should reject your client, not because the client is bad, but because you don't have any experience in banking and you might not be able to catch fraud, you might not be able to catch misstatement, right? And also, if the client is too bad, you should be, if the client has been kicked out by 10 auditors already, then maybe you should not accept such a client as well, right? For continuous clients, from your experience, clients were very, very messy, right? You don't want to with them because you think they were too much risk for you, then you might discontinue with the clients. So as an auditor, you first need to make a decision, right? Should I take this new client or should I continue with this existing client, right? Let's check their reputation. Let's check their general information to make a decision. Because once you decide to accept the clients, you can still quit, but the quitting is going to be ugly for everybody in this. Just like marriage, something like this. The good thing about auditing is it's once a year, right? So you don't have to wait for too long to, you know what I mean? And after you accepting the client, right? I mean, when client comes to you, you're not technically client yet. Client will bring some of the information. You might call a few friends, and from the industry insights, you heard something about the clients, right? But let's be honest, you don't really know the client because you don't have, by law, you cannot have access to their internal information, right? You need those information to make a better decision. So after you accepting the client, phase 2, you need to perform risk assessment, right? Risk assessment, let's refer to the books, right? But risk assessment including understanding client's business, understanding client's industry, operating style, understanding what is the current economy, what is current political environment, how it's going to affect clients, how volatile client's performance might be subjecting to those factors, right? Also understands from client's operating style, business style, and general thinking scale, understand client's operating, especially finance-wise, what might go wrong, right? What might go wrong? So when we talk about performing risk assessment, we're actually talking about two things, right? One, performing inherent risk assessment, right? What is inherent risk? Those risks, the client cannot change, auditors cannot change either, right? For example, in what industry? Hey, that's the industry. If you choose oil and gas, you're going to be subject to, for example, some riots in Middle East and some environmental issues and a global economy, a political economy, those things, right? You cannot avoid it. On the other hand, if you choose to grow, let's say, raise cows, right? Like steak, raise cattle, right? Then you're more subject to weather, right? Instead of global, political economy because everybody eats. Also, if you're in the utility business, like Reliance, government has very detailed rules. You cannot charge too much. There's always a surcharge. Government regulates how much profit you can charge. And there's always a meter everywhere. So it's easier to understand, right? To check, less risk. They may have efficiency issues, hire people that they should not hire, but at least financial statement is quite clear. On the other hand, if you are in a, let's say, more complicated business, right? Like those, something, in a more complicated business, then it's going to be different, right? Any business is less regulated, you're going to be facing higher risk from the regulation perspective. So that's the inherent risk we are talking about, right? After knowing the inherent risk, right, company auditors also think about, hey, given our understanding of the clients, what might go wrong, right? So they think about what might go wrong to gain an understanding of what policies, what the rules companies, the clients should have in place, right? That's phase 2, we call performing risk assessment. Understanding what might go wrong is particularly to the client is risk assessment too. Right, then in phase 3, from the knowledge obtained from the previous analysis and from the understanding of what might go wrong, then auditors need to check, right? How about their internal control over financial reporting? How good are their rules, are their systems in preventing and detecting fraud and misstatements, right? If the system is really good, auditors don't have to spend too much time later collecting too much evidence, right? This is evidence too we're going to talk about in the next stage, right? If clients is really messy, auditors need to know they will do a lot of work, right? So keep in mind, we talk about testing internal control, right? Testing internal control. This is phase 3. You need to test internal control. Auditors don't necessarily need to test internal control. Auditors do, and most of the time auditors do test internal control because testing it will make their whole auditing process much more smooth, save a lot of effort. If auditors have no knowledge of internal control, they have to check everything because they don't know what might go wrong. They don't know which one is more important and which one is more risky. They got to check everything, right? With internal control testing, auditors can be more specific. Hey, I feel more comfortable about this, so I don't need to put too much manpower. I can sample a smaller portion. That is more risky, so I can concentrate my resources over there. So it's more scientific, right? Make it better. Auditors do this. Auditors don't have to perform internal control tests unless it's required, right, by clients. But auditors usually, 99 out of 100 times, auditors test internal control because it's just to make their life easier. There was once I had engagements, I didn't test internal control. So we had a new company in town, right? It's not a new company, it's an international company just opened a head office, rep office, not head, a rep office in the city. So they opened up in early December, right? After they opened up, they hired a chief admin with 2 employees and 1 rep from the head office. So 4 people. They bought a furniture, they signed a lease, paid the first month of lease, and they pay 1 month's salary for 4 people, right? So I was lucky, I was asked to audit and it was 1 helper. So it's a 1 month engagement, and I went there and I told my assistant, my junior staff, I told them that, hey, look, it's gonna be easy. Just go there and check everything. And he was fresh out of school. He asked, why do we do this? Don't we do internal control tests? I said, look, we should, but look at this company. They've been here since like 20 days ago or things like 30 days ago, right? And in that year, they operated for less than a month, right? They bought furniture, they leased the office, they signed the lease, they paid salary for 4 people 1 month. And they had electricity bills, water bills. They didn't have it because it was all allocated in the lease, right? So what do we have to do? Instead of changing, they haven't started operation yet, right? They are just buying, settling down. So instead of doing some not so smart control test, wasting our time, why don't you just go ahead and collect everything? Let's do 100% audit because it's really doable this time. So for the 1 month engagement, we finished in 2 days, 2-3 days, right? That's great. So it depends. So right, if you test clients' internal control, the reason you don't test clients' internal control is because reason number 1 is what I said, it's less efficient to test, right? Reason number 2 is client has no internal control. You don't trust it at all, right? So if you trust client's internal control and you want to rely on it, you have to test internal control, okay? For example, if you think there's a policy client should have, answering to what might go wrong, 1 thing might go wrong, and a client don't have it, control risk is 100%. If a client don't have it, but have something actually similar, then you should test it. We're gonna talk about the testing in detail later, but you should test knowing how effective this internal control works. Are they really carrying it out? Are there people really signing? Are they really separating cashier's job with other bookkeeping jobs? So all those things need to be tested, keep in mind, all right? So after understanding internal control, right, let's think about it. Before we take the class, I think many people think auditing is checking numbers, right? So if you recall, we need to tell people whether the financial statements have material misstatements. What are misstatements? Misstatements are, we know there's a de facto number, factual number. There's a number presented, right? We compare the presented number in the financial statement to the actual number through our work to tell people whether there are misstatements or not. So we have to go to the number. We have to go to the number. Did we go to the number yet? We have not, right? So where do we go to the number? In phase 4, we go to the number. After getting our knowledge from internal control, from the inherent risk, we know how much work we will do, meaning that we know how many samples we take, right? For example, AR, there might be 1,000 balance client accounts. We might only to take 50, right? So we take the 50 to work, okay? This is called a test of details. We do test of detail, okay? This is called a substantive test stage. So this is called a substantive test stage, right? We're gonna talk about detailed process of substantive tests. But remember, in this stage, what we generally say is auditors really compare evidences with numbers. Because only if you compare evidences with numbers, you can have to compare, right? Evidence can be invoices, can be bank records, can be anything, but we have to compare numbers, that accounting numbers, to evidence to know whether something really is stated or not, right? You cannot tell whether there's misstatements or not by testing internal control, because internal control might be really bad, right? But accounting numbers can still be fun, and if you only understand the system, the policy, and you know the system's policy is effective or not, there's no way for you to tell whether financial statements have misstatements or not, right? So phase 4, we have to do it. We cannot skip it, right? And in the last phase, phase 5, basically all the work is done. Auditors gather everything, review and discuss adjusting, talk about numbers. Then they conclude the financial the auditing and give audit opinion, right? So we're going to talk about phase 5 is going to be our last stage for this particular class as well, right? How auditors do it. We're going to talk about this in a greater detail, but how auditors do it. Auditors based on, right? I mean, there are so many accounts, and it's such a waste of time if we ask people to do one account, because many accounts can be cross-referenced to each other, right? So let me ask, if your auditing fails, which accounts you might often refer to? All right. Cash is an answer, but cash is essentially related to everything, right? Everything, expense will be related to cash, revenue will be related to cash, dividend will be related to cash, inventory will be related to cash, right? Cash is everything, that's correct. But if you are auditing sales, you have to look at accounts receivable. If you're auditing accounts receivable, you have to look at sales, right? And if you're looking at the inventory, you have to look at accounts payable, because nowadays most are credit purchases, right? And you have to look at the debt in the group, you have to look at the equity in the group, okay? And there's also tangibles, intangibles, long-term assets, current assets. My point here is when auditors are auditing, they don't audit a single account, look at it from a standalone perspective, okay? You need to be correlated. You correlate to the most related accounts, and we call this accounting cycle. And there are a couple of cycles we're going to talk about after our first exam. But pay attention to this is cycle, right? And in the auditing, auditors obtain audit performance following audit procedures. And we got to understand those audit procedures, okay? For internal control, basically we have inspection, not only for internal control, common procedures, we have inspection of documents, inspection of assets, like inventory take, you will do. And we have observation, external confirmation, recalculation, reperformance, analytical procedure, scanning, and inquiry. And more than that, we're gonna list everything, okay? And when auditors do their job, remember, documentation is very, very important. Auditors' documentation is called working papers, right? Working papers help you clear your thoughts, do your work, help you when you report to your supervisor, help you to clarify what you did and what's the reason for it. And even in the worst case, in the courts, working papers help you to defend yourself, showing people you are not neglecting, you are not gross neglecting anything, and of course, you are not a scammer. So working paper is going to be very, very important. And in working paper, we have audit program, and analysis is prepared by the clients of the auditors, right? Analyze the clients, and we will have some memorandum and summaries of significant findings out of issues. But most importantly is what auditors did, right? What you did, okay? And in the last, in the last stage, right? So in the last part, when we say phase 5, when auditors conclude the audit, keep in mind, right? Client will always, I never had a client so clean. Client will always have some misstatements, right? Client's the raw financial statements prepared by the client, they are not open to public. They does not have to be what the clients will disclose to the public. And the auditors care about what it is disclosed to the public, right? So after auditors do their job, auditors will make a summary of adjustment. Hey, those accounts, those numbers are wrong by how much? Those are the adjusting journal entries we need to correct, right? They will negotiate with clients. If client agrees, I'll take most of it at least, right? To make the financial statements contain no material misstatements anymore, then the opinion will still be clean, right? If client rejects, only take a few, I'll take none of the adjustments, and the auditors determine, hey, even after these, those financial statements still contain material misstatements, and the financial statement users who rely on the financial statements to make decisions might be misled, and something unfair is they might sue us as well, right? So auditors, they will issue qualified opinions or adverse opinions, actually opinions saying that the financial statements are not good, right? So keep this in mind. Auditors cannot stop clients from disclose what they want to disclose, right? But auditor's weapon, auditor's tool is a financial statements or opinion, audit opinion, right? Auditors can, through, nobody wants audit opinion to be bad, right? So knowing that by disclosing financial statements containing material misstatements, auditors will issue qualified or adverse opinion. Client will be most likely to follow auditors' instructions, take adjustments, or at least negotiate really hard with auditors. All right, so let's keep this in mind. This is a general thing about this is an important part conceptually. I want us to really understand it and be able to ask questions. Okay, that's all for chapter 5. We're gonna do chapter 6 later. Bye-bye.